Okay, guys, so we are going to begin chapter 1. How many of you have ever taken an accounting course before? So a couple of you have, so it won't be just totally new scoop, but for a lot of you it will be. So it's always great to have a refresher. Accounting, financial accounting is the class we're in. A lot of people equate accounting and math. And if you're not good at math, you're freaking out about accounting. But accounting is not just about numbers. It's a lot more than numbers. What we're going to understand in this class that accounting measures transactions and then communicates those transactions to the end user in the form of what we call financial statements. Financial accounting is this class. Some of you may be taking the next class called managerial accounting next semester. But financial accounting is providing or communicating information to the end user. The end user in financial accounting is the public, external users, not people within the company, people outside the company. What we're doing is we're going to learn how to measure business activities for a specific company, and then we're going to communicate what we're measuring to those people outside, such as banks or the public or shareholders. And they need this information to help make decisions. So, why do people need to make decisions? Well, if you think about it, if you're an investor, because you have a 401k plan or cash that you invest in, you want to decide, hey, what's the better company to invest in? Or if you're a bank and a business wants money, you need to find out, is this business going to be sustainable? Is it profitable? How's it doing? Or customers, I can't tell you how many people I know that buy furniture online, and then the company goes defunct. And they pay for their customized couch and they never receive it. So oftentimes customers want to make sure, do I want to do business with this particular company? Are they going to be around? Are they going to be a going concern in the future? Suppliers, are they going to get paid? Managers decide production and expansion. So managers, this is someone from within the company, and that's going to be another course that helps give information for managers or employees. Competitors want to see how they're faring with other people in the same sector. Regulators, tax authorities, and local communities, people in the community. So know all these different things. Banks, environmental issues, they want to see your financial statements. Know that people, external users, want to make decisions about companies. And what we do, these companies have various activities based on what they do for a living, what their business is around for. And these activities that companies perform get measured by accountants. And those accountants take all those activities and put them in a form of financial statements so they can communicate to the users information about the company. Do you see the cycle of how the information is being used? This course is financial accounting. This is where we provide information for external users outside of the company. Managerial accounting, another course I teach, that sometimes your degree will require that you have both, it's accounting that provides information for internal users. So if you think about it, guys, if I'm an external user wanting to invest in a company, do I care if they're going to put more focus on making umbrella strollers versus the big prammy strollers? No. Managers care about the detail. What makes more money? How can we raise our profits? External users want to see the bigger picture. Make sense? So the difference between the managerial accounting and the financial is a real big picture of a company. Managerial accounting helps individual managers make decisions about the company, and that's going to be on a much more detailed level. Any questions so far? Am I going too fast? Will you tell me if I am? So as you see, remember, every transaction that happens with a company, we're going to get our hat on and start thinking, how is this business activity we're looking at being measured? And then how do we communicate this activity? We're going to go into details in the next couple of weeks. So guys, which definition below best describes financial accounting? Is it the process of measuring income taxes owed to the government? Is it the system of maintaining communications with a company's customers and suppliers? No. Is it procedures designed to enhance the company's image to potential investors? No. Is it measuring business activities and communicating them to external parties? Does that sound kind of familiar? That is the correct answer. How about this one, guys? Financial accounting does not deal with which of the following? Anyone have an idea? Are we measuring a company's economic activity? Yeah. Are we preparing financial reports? Yeah. Are we trying to communicate those financial reports to investors? Yes. But are we providing information for internal users? No. Okay, remember it's to external users. So, companies perform 3 types of activities: financing activities, investing activities, and most of the activities companies perform are under operating activities. I will tell you that. Operating activities are transactions that relate to the primary operations of a company. Okay, so let's just say this school. Because Anoka Ramsey, and granted, this is a nonprofit, but let's just pretend it is a for-profit school. The reason Anoka Ramsey is in business is to provide an education. So tuition, paying for utilities, paying for books, paying for equipment, paying teachers' salaries. All of that is the normal operations of this business. Does that make sense? Financing activities only relate to transactions the company has with investors and creditors. What does that mean? Selling stock to investors, borrowing money from the bank, paying money back to the bank. Does that make sense? How they finance, how they receive their money, be it through stockholders or borrowing money from the bank. Got it? That's it. Investing activities only deal with the purchase and sale of pretty much long-term assets that provide benefits for several years. So purchasing a building, selling a building, purchasing equipment, and when I say equipment, not a $2,000 piece of equipment, but a truck, okay? Also, investing activities have to do with purchasing stock in another company. Now, financing activities are issuing stock to the shareholders of that company. Investing, when a company purchases stock in another company, that's long-term assets, okay? They're called long-term investments. Does that make sense? Every activity will fall under one of these three. Financing, issuing stock to have shareholders, or borrowing money, investing, purchasing factories, equipment, trucks, long-term assets, assets that last for more than 1 or 2 years. And then operating activities is everything else. So if we're dealing with a Home Depot, the inventory is why they're in business. They purchase inventory to resell, don't they? Or their employees, when they pay their employees, operating, maintaining their building, paying for the utilities, paying for upkeep, paying insurance policies on the building or the employees. Does that make sense? Why the company's in business. How are you guys doing so far? There are different types of business organizations, meaning a business can be organized under various means. A corporation is a company that is legally separate from its owners. What that means is it is technically a separate individual entity from the owners of the company. The advantage of being legally separate is that the stockholders have what's called limited liability. What that means is they can't be sued or the most that they can lose is the amount of stock they have invested in the company. A sole proprietorship is a business that's owned by only one person. One day you say, hey, I'm going to start snow plowing. Although this year would not be a good year to start snow plowing, would it? We've been gone for 6 weeks, but we have a little Ring doorbell. We haven't had any snow. I mean, I think yesterday was the first day we had like an inch. Not a good day to start good year to start snow plowing. But you could just one day wake up and say, I'm going to start snow plowing. Send out cards, start snow plowing. You're a sole proprietor. A partnership is a business owned by 2 or more people. Okay? Neither the sole proprietorships nor partnerships offer limited liability. Now, guys, there is a big company, a big form called an LLC, a limited liability company. That is similar to a corporation in that they do offer protection. So those are the types of organizations. We've got corporations, we've got sole proprietorships, and we've got partnerships. Sole proprietorships and partnerships do not offer limited liability. Meaning, if someone goes after a sole proprietorship, they could end up having to pay out more than what they have invested in the company. So, today, this is the most important concept you're going to learn today. This is called the accounting equation. The accounting equation is assets or resources will always equal liabilities, which are what we owe outsiders, plus the stockholders' equity, what owners have given for shares in the company, plus the retained earnings. So assets or resources will equal what we owe and what we own. Okay? Assets are the total resources of a company. Liabilities are the amounts we owe to creditors. And stockholders' equity are owners' claims to those resources. The accounting equation this is the key to accounting. It will always balance because assets will always equal liabilities plus stockholders' equity. Okay? Yes? You bet. Let's just think real quick. Assets. Assets are resources. Cash is a resource. This building is a resource, right? The equipment are resources. Things we use that will provide us a benefit today and in the future. Okay? Liabilities are when we owe money to banks, when we owe money to suppliers or creditors. Okay? Revenues are the amounts recognized when the company sells products or provides services to customers. So I have a CPA business, and I'm getting ready to gear up, and we provide a service preparing people's income taxes. We provide the service, and when we hand the return over to them, they pay us for those services. That's a revenue. Got it? Revenues can also be you go into Home Depot and you need to buy paint. You buy 3 gallons of paint. You pay them $90. Got it? That $90 are revenues or sales to Home Depot. Does that make sense? Expenses are the costs of providing products and services and other business activities during the current period. So at my CPA practice, I have expenses. I pay rent. I have employees. I pay employees to work. I have software each year. I pay for software. I have insurance. You see what I'm saying? I have paper. I have supplies. All of those are costs for providing those services. Anyone, can we think of a company and let's just kind of talk about it? Anyone work somewhere? Yes. You work at Cub. Awesome idea. Cub. Cub receives revenues from selling groceries. Okay? They do a lot, but let's just overall, they sell groceries. What are the costs that are incurred with selling those groceries? Buying the product, isn't it? Buying the inventory. Paying for the maintenance on the buildings. Paying for stockers. Employees for checking out. What else is there, guys? Yes? Shipping things in. The insurance. Okay? the maintenance on all their equipment, their refrigeration. Revenues are what's recognized when a company sells products or provides a service. Expenses are the cost of providing those products, or selling the products or providing the services. Net income is the difference between revenues minus expenses. Sometimes we can call it earnings, or we can call it a profit. So you have different names, but we're going to call it net income. Okay? So we're learning another equation here. Revenues minus expenses equal net income, right? Dividends are cash payments to stockholders. So let's just think about this a minute, okay? I need money. And I want to hire, I need people to invest in Shoemake CPA, which means I want them to be shareholders in my company. So they give me $50,000. Well, don't they deserve something? They're investing with the expectation they're going to get a return on their investment. And so dividends are what is paid to shareholders of a company. It's basically returning some profits to them, right? Dividends are cash payments to stockholders. Guys, dividends are not expenses. They're paying them back a piece of the profits. Dividends are not expenses, okay? Okay, who wants to take this one? Financial accounting does not deal with which of the following? What do y'all think? Oh. Hey, let's see if anyone remembers these. Sorry. Okay, now we've got two equations that we're picking up. The accounting equation is the most important. Assets equal liabilities plus stockholders' equity. Okay? Dividends, we know, are distributions paid to shareholders, basically for them investing in the company. And then we know that revenues minus expenses equal net income. Now, guys, do you see right now we're already getting an understanding of various activities a company performs? Companies perform activities related to assets. They perform activities related to borrowing money or paying back money or getting shareholders. Businesses perform activities related to selling goods and services and costs associated with those goods and services. Do you see what we're going to start doing is breaking down various activities and putting them into certain lumps? Okay? So we're going to just keep it real simple here. No, the measurement rule of accounting is to create a record of the activities of a company. And in order to do this, companies have to keep good records. They have to know all the activities associated with recording its assets, its liabilities, its stockholders' equity, revenues, expenses, and dividends. So what are the total resources of a company, guys? What are they called? Assets. The amounts recorded when a company sells products or provides services to customers are referred to as
Revenue?
yes. Dividends represent the payment of cash. But they are not what, guys? They're not, guys, you're going to see that again. Okay? They're not an expense. Students sometimes mistakenly include the amount of dividends as an expense in the income statement, rather than as a distribution of net income in what we call the statement of stockholders' equity. So, again, assets can be cash and can be equipment. So let's just say that a particular company has $11,000 of cash and $24,000 of equipment. These are both assets. They're resources. The $11,000 plus the $24,000 equals $35,000. Do you see that the assets equal $35,000? The liabilities, like what we owe, is $10,000, and the stockholders' equity is $25,000. The liabilities plus the stockholders' equity equals $35,000. Do you guys see our assets of $35,000 equal our liabilities plus our stockholders' equity of $35,000? They have to. It must always equal. After every single transaction, the accounting equation will always equal. Or, if we're saying assets equal liabilities plus stockholders' equity, this is really simple math. If we bring the liabilities over to the other side, wouldn't it be assets minus liabilities equal stockholders' equity? Okay? It just always equals, guys. It has to. Okay. I don't know why I screwed that up and have that in here a couple times. Sorry, guys. So, we're going to take a moment and let's just look at, on the right-hand side, these different items, and let's match it to the other side. Land owned by a company is what, guys? Bless you. What is land owned? Yes.
An asset?
An asset. It's a resource. Amounts owed to the bank, you guys can just yell it out too. Liability. We owe. Common stock issued to investors. Stockholders' equity. Payments made to stockholders. Dividends. Cleaning services provided to customers. Revenues. Workers' salaries for the current period. Expenses. Is this making sense, guys? Yes.
I have one question.
Yes.
So for that general equation for the liabilities,
Uh-huh.
I'm wondering why we're adding it in order to get the total assets. Because if you owed like 15 to the bank, I would think you would subtract it in order to see how much.
Okay, let me explain what you're asking is a great question. Let me explain something real quick if I can pull up an Excel sheet. Let me show you what, see, and guys, ask these questions because what I want to help you do is gain a clearer understanding. Okay, let's just say I want to purchase a building for my business. I don't want to pay rent anymore. So I want to buy a building for $300,000. So I want to buy a building for $300,000. In order to do that, I need to take out a loan for $250,000. Okay? Got it? So this building is a resource, right? This resource happened because I had to borrow money of $250,000 and I used cash of my own of $50,000. Okay? So the reason this might not be it, how about instead of confusing you right now, let's just say I had to borrow the whole $300,000. Okay? Just to keep it simple for you. Do you see why assets equal liabilities plus stockholders' equity? Because to purchase this building, how did I purchase it? All alone. Okay? Now, what I was trying to do earlier, which I don't want to confuse you, if I purchased a building of $300,000 and I took out $250,000 and borrowed $50,000, okay? So, do you see how using cash is an asset, right? Taking out a building increases my resources or assets by $300,000. But if I use $50,000 in cash, what happened to my assets, my overall assets? Didn't they go up $250,000? See? And what is my loan? Do you see again how assets are still equaling liabilities plus stockholders' equity? So think of it as resources come from either stockholders' equity investments or we borrow money. Okay? It's always got a balance. That's what we're kind of saying here. When I want to buy a truck, that truck is what? It's an asset, right? And if I go to the bank and borrow money, isn't that a liability? So after that transaction, if my truck costs me $50,000 and I have a truck loan of $50,000, do my assets after that transaction, are my assets equaling my liabilities plus stockholders' equity? What if I purchase a truck for $50,000 and I pay $50,000 in cash? Didn't one asset go up and another one go down by $50,000? But do we still balance? Do you understand what I'm trying to get at without overwhelming you? Okay? Let's go back. Did that help? And if I still don't explain it well, you say, no, I need to understand again. Okay? Now, I will tell you this is a problem on your homework, so even if those people who are watching this, they'll get help on the homework. There are two companies. There is Falcon and there's Wildcat. Falcon Inc. has the following transactions with Wildcat. Falcon, how is each classified in the income statement? Revenue or expense, balance sheet. Falcon purchases common stock of Wildcat. So this isn't that Falcon is getting Wildcat as a shareholder. This is Falcon has cash and they're going and investing in another company. An investment is what kind of transaction? Isn't it an asset? And remember, there are 3 types of activities: financing, investing, and operating. When Falcon goes and purchases an asset, a long-term asset in another company, like an investment, that type of activity is an investing activity, isn't it? Right? What happens when Falcon borrows money from Wildcat by taking out a loan? It's a liability. I'm going to give you a secret. Every single liability, apart from one we'll talk about next week, has the word payable after it. You know it's a liability because it has the word payable after the name. So guys, you'll always know it's a liability because it says payable, apart from one we'll talk about next week. So when this happens, what type of activity is borrowing money? Isn't it financing? And it's a liability. Excellent. Now what happens when Wildcat, okay, because Falcon invested money in Wildcat. But guys, Falcon's reason for being in business is investing money in different companies. Just like this school is to teach people and so that your tuition is their revenue. Just like I'm doing taxes and my revenue is preparing tax returns. Falcon's line of work is investing in different companies. And the way they receive money is by getting dividends from all these different companies. So if the account is called dividend revenue, what kind of activity is it? It's a revenue it's a revenue. They're bringing in money. And this is why Falcon is in business, is investing in other companies and receiving the money. So it would be an operating activity. It's why they're in business. Yes?
How often do they send out like dividends?
Usually quarterly.
Does that mean land could be considered a liability because you have to pay property tax on it?
Good question. No. Land is a resource. That land allows you to do something with it. It's a resource. The property taxes would be an expense. But guys, you see what you're doing is you're starting to think of things and then you're asking questions. This is how it's going to click in with you. Okay? So the land is the asset. How you get that land. Let's say I want to buy a $500,000 piece of property. Well, I don't, most of us just don't have that money. So we have to go borrow money. Borrowing that money would be the liability. The land in itself is the resource. The borrowing the money is the liability. Does that make sense? We take an activity and we pick it apart. Okay? For some, land will always be the resource. Some people might have the cash to go buy that land. So they're using an asset to buy an asset. Some people may have to borrow money to buy that asset. Does that make sense? Next, Falcon provides services to Wildcat. So now Falcon is providing some type of service to Wildcat. If it's providing a service, we call it service revenue. What type of activity is this? Wouldn't it be operating because it's why the company's in business? And it would be a revenue? Most revenue accounts are going to have the word revenue after it. Okay? Falcon pays interest to Wildcat upon borrowing. So guys, just like a liability has the word payable after it. Same with expenses. Every single expense will have the word expense after it. So what do you know it is? It's an expense. Right? And expenses and revenues are part of why the company's in business. They're operating. Okay? We always know revenues and expenses are going to be operating. So let's look here, and we've got different transactions, and let's decide what is it. What type of activity is this? When we borrow money from a bank, what are we doing? Wouldn't we be financing? When we provide services to customers, what are we doing? Operating. When we issue common stock to shareholders, what are we doing? Financing. It's our way of getting money. When we purchase land, what are we doing? Investing. When we pay rent for the current period, what are we doing? Operating. When we pay dividends to shareholders, we're financing, because remember, when we issued stock to those shareholders, it was financing. So paying the dividends to those shareholders is part of financing. Okay? When we purchase a building, investing. Yes?
Right, so why is paying rent operating?
Because it's an expense. Revenues and expenses are the reason the company's in business. Okay? So revenues are the reason the company's in business and the way they make their earnings. And expenses are costs associated with making the revenues. So guys, know anything to do with revenues and anything to do with expenses are going to be operating expenses. Why the company's in business. Make sense? Guys, what are transactions related to the primary business activities of the company, such as selling goods and services to customers? Operating. Transactions of a company that include the purchase and sale of long-term assets are vesting. Now, how do we take this information and communicate it through financial statements? There are 4 primary financial statements. The income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows. The income statement, here, I'll wait a minute. Okay? The income statement are revenues and expenses over a period of time. Revenues are why the company's in business. The expenses are the cost associated with making those revenues. If revenues are greater than expenses, that's what we want. We want a net income. If revenues are less than expenses, then we've got a net loss. And a company can't sustain a net loss over and over again, can they? Some do, I don't get it, but you can't make it for long. Right? Get your subsidies, that's the truth. But that's a whole nother story I'm not going to go into. Remember, the income statement compares revenues and expenses for the current period to assess the company's ability to earn a profit from running its operations. Okay? Here we have Eagle Soccer Academy. Eagle has revenues as of December of 2024. It has revenues of $72,000. It has expenses of $58,000. And it shows a net income of $14,000. Now I'm going to show you something. The revenues always have the word revenue after them, doesn't it? The expenses always have the word expense after it. That's how you know it's an expense. On your homework, so many times there will be a payable and someone will show it as an expense. What's a payable? A liability. An expense will have the word expense. That's how you know it's an expense. And the only thing that goes in an income statement are revenues and expenses. Got it? Here is Eagle Soccer Academy's statement of stockholders' equity. What is in the statement of stockholders' equity shows the common stock. Retained earnings are the earnings that have been retained in the company since its inception, which means their net income year after year, minus any dividends that get paid out. So when a company has net income, they need to pay a piece of that net income to the shareholders. So do you see in a statement of stockholders' equity section, you have two columns, common stock, and you have retained earnings, and it totals it. The common stock just shows the stock that has been invested in the company. The retained earnings shows if there was a beginning balance, but in this case, the soccer academies began this year. At the end of the year, it earned $14,000 in net income, and it paid $4,000 to its shareholders. Okay? This shows the statement of stockholders' equity. What we want to do here is prepare an income statement. Now, guys, income statement includes revenues and expenses, right? So, the revenue is $75,000. The expenses are all here. This shows our net income, $22,000. Remember, an income statement only has revenues and expenses. That's it. Okay? Now, in order to prepare a statement of stockholders' equity, it tells us the balance of common stock at the beginning of the year was $200,000. We put it in there. The balance of retained earnings at the beginning of the year was $32,000. Okay? Then it tells us during the year, the company issued additional shares of common stock for $25,000 and paid dividends of $10,000. So it's telling us where everything goes. But the one thing we have to do is add the net income from our income statement to this statement. So you have to complete your income statement before you can complete your statement of stockholders' equity. Does that make sense? Yes? Am I doing okay with time? Yes. Okay? Then you have your ending balances. This is called the statement of stockholders' equity. Summarizes the statement of stockholders' equity summarizes the changes in stockholders' equity over a period of time. Just like the income statement shows the revenues and the expenses of a company over a period of time. Okay? The balance sheet is a snapshot. This presents the financial position of the company on a specific date. It's a snapshot. Okay? It's not over a period of time, it's just at the end of a period. And the balance sheet is going to look familiar to you. The balance sheet shows the assets of a company are going to equal the liabilities plus the stockholders' equity of a company. Hey guys, you've seen this before. What is this called? The accounting equation? Do you see how the balance sheet is the accounting equation? Got it? The best way I can say is it's a picture. It's just a snapshot. So a company on December 31st might have cash sitting in the bank of $20,000 and assets of $30,000 and liabilities of $50,000. Let's just keep it simple. But on January 1st, they could take $20,000 of their cash and pay down a loan, pay down debt. And all of a sudden everything changed, right? Now their assets are different. Their liabilities are different. That's why it's a snapshot, because the next activity will change it all. The balance sheet for Eagle Soccer Academy shows various assets: cash, accounts receivable, supplies, net equipment, and other assets of $350,000. Do you see the liabilities have the word what? Payable. You know it's a liability because they have the word payable. And then they have other liabilities, which is a liability, okay? Of $140,000, the stockholders' equity is $210 for a total of $350. Do you see our assets equal our liabilities plus our stockholders' equity? Yes? Which of the following accounts would appear in a company's income statement? Think about it. What's in an income statement? Revenues and expenses. No, accounts payable is a liability. So what's in an income statement? Revenues minus expenses. Rent expense would be in the income statement, right? What relationship is reflected in the balance sheet? What's our accounting equation, guys? Assets equal? Yes. Guys, if there's one thing you remember today, it's that accounting equation. Okay? That accounting equation is the balance sheet. Now there's another financial statement called the statement of cash flows. It basically takes all activities involving cash receipts and cash disbursements over a period of time. And it breaks them into operating cash flows, which is why the company's in business. Investing cash flows is the buying and selling of long-term assets and investments. And financing cash flows is borrowing money, paying back money, or issuing stock. Right? And paying dividends to shareholders. So, here is the statement of cash flows. It shows from operating activities cash coming in from customers, cash going out for expenses, and then it shows purchasing equipment, and then it shows issuing stock, borrowing from the bank, and paying dividends. and it shows everything that happened during the year involving cash. Do you see? Our cash at the end of the period is $137,000. This is another statement. What happened to our cash during the year? What did we do with it? Where did it come from? Did it come from just borrowing money, or did we get revenues from it? Okay? Here, Tiger Trade had the following transactions. Cash at the beginning of the period is $5,000. Here we see cash received and cash paid. Money in, coming in, money going out. What we do is we show, we started with $5,000. We're showing cash came in from the sale of products to customers, that's a plus. Cash received from the bank for a long-term loan, that's a plus. Cash paid to purchase factory equipment, that's a minus. Cash paid to merchandise suppliers, that's a minus, meaning it went out. Cash received from the sale of an unused warehouse, that came in. And then cash paid to workers, that went out. Cash paid for advertising, that goes out. Cash received from the sale of services to customers, that comes in. See, I'm just right now trying to figure out a balance. Cash paid for dividends to stockholders, that goes out. So what we did is, we know what the beginning of the period is, we know pluses and minuses, and what our ending cash balance is. You see that? Now what we need to do is, let's take each of these and decide, is it operating? Is it financing? Or is it investing? So guys, we know anything to do with why the company's in business is operating. So when we receive cash from the sale of products to customers, isn't that operating? When we receive cash from services to customers, isn't that operating? When we paid out merchandise suppliers, it's like a Target or a Home Depot. We're a merchandising company and we're buying product to sell. Isn't that why the company's in business? When we pay for workers' salaries, isn't that an expense? Or for advertising, wouldn't that be an expense? Does it make sense? So what we did is we took these activities related to why the company's in business and we put them in the operating section here of the statement of cash flows. Then, purchasing factory equipment, that's an asset. When we purchase a long-term asset, it's an investing expense, right? So we used up that money, and then we sold a warehouse. What is a warehouse? Isn't it an asset? So the purchase and sale of long-term assets go in investing. The paying for factory equipment and the receiving the sale of the warehouse, the minus 50 plus the 13, doesn't that give us minus 37,000? And then financing is when we borrow money from a bank and when we pay dividends. So do you see, if we take the 30,000 minus 37,000 plus the 39,000, we come up with 32,000. Then we take what we had at the beginning of the year, 5, and you see we have cash at the end of the year of 37, just like we have here. This, guys, is the statement of cash flows. I'm going a little fast because I don't want to lose out everything. Then, in this example, we've got our assets, we've got our liabilities and our stockholders' equity. We know it's a liability because it has the word, what after it? Payable. And then we have this information from cash inflows and cash outflows. So basically, to create a balance sheet, we're going to show our assets, we're going to show our liabilities, and we're going to show our stockholders' equity. Do you see our assets equal $85,000? Our liabilities are at $33,200. Our stockholders' equities at $51,800, but the total is $85,000. Do you see how our assets equal our liabilities plus our stockholders' equity? And then, I'm sorry, I'm not stopping through this, but if you go back and look, we separate those activities into, are they operating activities, investing, or financing? And here, that $7,700 of cash at the end of the year has to match the cash shown on the balance sheet, doesn't it? Doesn't that make sense? So you see all of these financial statements linked together. The net income needs to flow through the statement of stockholders' equity here, doesn't it? Then, the statement of stockholders' equity, we need these figures because we're going to put this total stockholders' equity down here. And the statement of cash flows, the cash of $6,900 better match our balance sheet cash. Okay? So I'm just going to go through this fast because, guys, I need to go through all the homework for you. So this will help you see just in an income statement, revenues minus expenses give us our net income of 9. You know, because remember, the income statement just shows revenues and expenses. The statement of stockholders' equity, if we increase the stockholders' equity to $17,000 and we issued common stock of 11 and our net income is at 12, what would our dividends be? They have to be 6 if our net ending balance here is 6. And then our balance sheet, if our assets become $24,000 and our stockholders' equity is 15, we know our stockholders' equity plus our liabilities have to equal our assets. Okay? Does that make sense? Then we've got just different, again, you guys might need to go back and look at this because I'm rushing you and I'm so sorry. If we've got our total change in cash for the year is $26,000, and we know our operating activities were 34 and our investing were minus 17, then we know our cash flows have to be 9 to make the 26. Does that make sense? Remember, all transactions that relate to revenues and expenses are put on the income statement. Okay? I am not going to finish this piece, but if you go through the review, you'll learn about the different professions in accounting, and we'll talk about generally accepted accounting principles are the guidelines we use in order to prepare these financial statements, so they're universal. And let's just see. Look at auditing. You might have some questions on this last generally accepted accounting principles and auditors. So please look at that and these various assumptions with GAAP. Again, I apologize, but I just want to get us to where I'm going through everything